Imagine you buy a car for $10,000 and then you drive it home and you open up the trunk and you discover $2,000 of cash in the trunk. Well, then technically the car actually cost you $8,000. The $10,000 price minus the $2,000 of cash that it came with. In this video, I'm going to explain what enterprise value is, the difference between enterprise value and market cap using real life examples, and I'll show you why using enterprise value instead of market cap will help you to avoid one particular major investing mistake. So to explain enterprise value, it's important to first understand what market cap means. And unless you're 1,000,000% confident in your understanding of market cap already, I'd highly encourage you not to skip this section. So the market cap of a stock is equal to the price per share multiplied by the number of shares outstanding. And shares outstanding, well, that's the number of shares that the company's ownership has been divided up into. So this literally means that if you own 1% of a company's shares outstanding, then you would own exactly 1% of that company. So looking at Apple stock here as an example, we can see right here at the beginning of their most recent financial statements that they have roughly 16.687 billion shares outstanding. Just by searching Google, we can see that the price per share as of right now is $131.46. And if we multiply this number by the number of shares outstanding, then we calculate that Apple's market cap is $2.193 trillion. Facebook has a price per share of $324.90 right now, and shares outstanding of 2.847 billion, and therefore a market cap of just under $925 billion. Berkshire Hathaway has a price per share of $412,500 for one single share, and they have a shares outstanding count of just over 1.5 million shares. And therefore, when we multiply those two numbers together, we get a market cap of $632 billion. Now notice how if we were to look at only the price per share, we really wouldn't have that clear of a picture. And that's because price per share on its own is actually completely meaningless. See, market cap on the other hand, at least has some meaning. You can think of market cap as the price tag on the entire company. Or in other words, it's the valuation that the market has put on the company. It's the price that you would need to pay to buy 100% of the shares outstanding and therefore own 100% of the company. Meaning that if you could snap your fingers and you could buy all of the shares outstanding from their current owners and paying the current share price for them, the amount that you would need to pay is that market cap amount, and then in exchange, you'd own 100% of the company. Now, I should point out, however, if you attempted to slowly buy up all the shares of a company, just the act of attempting to buy up all the shares would actually end up causing the share price to slowly rise. Nonetheless, the takeaway here is that market cap is the price, or in other words, the valuation that the market is putting on a company. Now, this price doesn't necessarily accurately represent the true value of a company, but that's a subject for another video, and I talk about that all the time on this channel. Bottom line, as you can see, public companies have a wide varying amount of shares outstanding. And you might be surprised to know that a company's number of shares outstanding is often changing all the time as well. This chart here shows Apple's number of shares outstanding over time, and it has been adjusted for the various stock splits that they've done in the past, by the way. And I'm going to touch on stock splits in just a second. Notice how in earlier years they were consistently issuing new shares, which is a way of raising cash from the public, and this caused the number of shares outstanding to increase. Then in more recent years, they've been buying back shares quite heavily, which has the effect of reducing the total number of shares outstanding. Share buybacks like this, by the way, are just a way of returning value to shareholders. It's basically an alternative to paying a dividend. Quickly, in regards to share issuing and share buybacks, when a company issues new shares, the percentage of ownership that each share represents decreases. And that's because the ownership is now spread out amongst more shares outstanding. And when a company buys back shares, the percentage of ownership which each share represents increases. Now, unlike share issuing and share buybacks, stock splits, on the other hand, change absolutely nothing about the fundamentals of the company. If a company does a 4-for-1 stock split, for example, what happens is that on the date of the stock split, the price per share will become 1/4 of what it was previously. And at the same time, you will now automatically own 4 times as many shares. Think of it like this. It's the same as if you and 3 other friends ordered a pizza, and so therefore you each own 1/4 of the pizza. A 4-for-1 stock split would be no different than splitting up the pizza into 16 equal slices, and now instead of owning 1/4 of the pizza, you now own 4/16 of the pizza, but at the end of the day, you still own the exact same amount of pizza. So quite literally, the only purpose of stock splits is to make the price per share lower and therefore more accessible to smaller investors. And often what ends up happening actually is that inexperienced investors believe that the stock is now actually cheaper and a great time to buy, but in reality, truly nothing has changed between the day before the stock split and the day after the stock split. It's all the same. Same as the pizza example, it's only a cosmetic change. Okay, so this video is about enterprise value, but you can't talk about enterprise value without covering market cap, and you can't really explain market cap without covering shares outstanding. And once you talk about shares outstanding, you kind of have to talk about issuing new shares and share buybacks, and then you got to talk about stock splits as well. Nonetheless, the main thing that you need to know about market cap is that it's essentially the price tag that's been put on the entire company. Or in other words, it's what the market thinks the entire company is worth. Now, if market cap is the price tag, then you can think of enterprise value as the true cost to buy the entire company. Enterprise value in its simplest form is equal to market cap minus cash and cash equivalents plus short-term and long-term debt. Now let's go straight into an example looking at Facebook stock, and in order to explain, let's start by figuring out Facebook's market cap. Today's share price is $324.90, and as per their most recent financial statements, Facebook currently has 2.847 billion shares outstanding. So $324.90 multiplied by the 2.847 billion shares outstanding equals a market cap of just under $925 billion. And if we look on the balance sheet, we can see that Facebook has cash and cash equivalents of $19 billion. And they have marketable securities of just under $45 billion. And also on the next page here, we can see a breakdown of that. So these are the cash and cash equivalents, and these are the marketable securities. And these government securities and corporate debt securities are pretty much as good as cash, so we're going to include them in our enterprise value calculation. So in total, for cash and cash equivalents, we have $64.219 billion. And going back to the balance sheet quickly, we can also see that Facebook has zero debt. And therefore, we can calculate Facebook's enterprise value as that market cap amount of just under $925 billion, subtract the cash and cash equivalents of $64.2 billion, equals just under $861 billion. This means that although the price tag on Facebook is just under $925 billion, the true cost to buy Facebook is actually lower at that $861 billion amount. An easy way to think about it is this. Imagine you buy a car for $10,000 and then you drive it home and you open up the trunk and you discover $2,000 of cash in the trunk. Well, then technically the car actually cost you $8,000. The $10,000 price minus the $2,000 of cash that it came with. Okay, so the next example we're going to look at is AT&T, and you're going to quickly see why it's better to use enterprise value instead of market cap once you see this. First though, here's the extended formula for enterprise value. So it's actually market cap, subtract cash and cash equivalents, plus short-term and long-term debt, plus preferred stock, plus minority interests. Cash and cash equivalents you already understand. Short-term and long-term debt is also pretty self-explanatory. This is just money that's been borrowed. Preferred stock is very similar to debt, and it's not that really necessary to get into the details of it right now, so just think of it as being similar to the company having debt. And then minority interest, which is also sometimes called non-controlling interest, is best explained like this. When a company buys another company in full, all of that company's revenues, expenses, assets, and liabilities all get combined together in the financial statements. So after the acquisition, the financial statements will reflect the operations of both businesses combined. Meaning, for example, if both companies made $1 million in sales each, well, the new financial statements would show $2 million in sales. And again, everything else would be combined as well, not just the sales. The two companies would literally be just completely merged, and the financial statements would reflect that. But when a company buys only 90% of another company, for example, then the financial statements actually still get completely combined regardless. So again, if both companies made $1 million in sales each, then the new financial statements would show $2 million in sales, in spite of the fact that the original company only owns 90% of the second company. In accounting, the way this is accounted for is that an item called minority interest or non-controlling interest gets added to the balance sheet. So when you see minority interest or you see non-controlling interest on a balance sheet, it essentially means that someone owns a small part of one of the company's business divisions. Okay, so AT&T has a market cap of just under $225 billion, which comes from the price per share of $31.41, multiplied by the shares outstanding amount as of February 12, 2021 of 7,131,763,496. However, now let's look at AT&T's enterprise value. We can see cash and cash equivalents is just over $11 billion. Short-term debt is $19.5 billion. Long-term debt is $160 billion. There's no preferred stock to add in, but they do have minority interest of $17.5 billion. This all equates to an enterprise value of just over $411 billion. So $411 billion would ultimately be the true cost to buy and own AT&T in its entirety, even though the price tag on this company, aka the market cap, is just under $225 billion. So therefore, what all of this means is that occasionally you might find a company that initially looks attractively priced relative to how much money they're making when looking at just the price, or when looking at a popular metric like the price to earnings ratio. But it can also mean that occasionally a company may not look as attractively priced as it actually is once you consider the cash and cash equivalents that you're getting along with your purchase. Most websites which show financial metrics, like a Yahoo Finance for example, do calculate enterprise value for you. So it's not something you're gonna need to constantly do yourself. But now you at least know where the number comes from, so you understand what it means when you see it. Some people, myself included, find it useful to look at the financial metric called enterprise value to EBIT, either instead of or in addition to looking at the price to earnings ratio. And that way you'll get an even more complete picture. If this video was useful, please consider sharing it with a friend. And please remember that I'm not your financial advisor. I'm just someone that loves business and loves investing. And I'll see you in the next one.